Good morning and welcome to the Energy Perspectives webinar hosted by PHX Minerals. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Hey, thank you guys for signing on. I know we're starting a little bit earlier, so I'm going to drag us out a little bit, but we'll wait until right at 10 o'clock before we really get into it. But today we have two members of the PHX Minerals management team that are going to speak today. Now, PHX Minerals is a publicly traded company on the New York Stock Exchange. As you can see, we do have, several minerals companies in our high yield income portfolio. So I'm very interested in minerals companies these days personally. So, okay, Chad Stevens is one of our speakers today. He is the president and CEO of PHX Minerals. Prior to joining PHX in 2019, he was part of the management team at Range Resources, which is one of our Sweet 16 companies that we've been following for over 10 years. He joined Range in 1990 as senior vice president of the Southwest. And in 2002, he got a new title, senior vice president, corporate development, a position he held until his retirement in December of 2018. While at Range, Chad was responsible for the origination, valuation, and acquisition or divestiture of over $4 billion of oil and gas producing properties. He also served as Range's internal hedging committee and was responsible for the oversight of all gas, oil, NGLs, marketing, and sales. Mr. Stevens holds a Bachelor of Arts degree in finance and land management from the University of Texas. He also joined us today is Ralph D'Amico. He is vice president, chief financial officer, and corporate secretary. Ralph joined PHX in January of 2019, serving as the company's vice president, corporate development and investor relations. And then he was promoted to chief financial officer on March 9th of 2020. Ralph has 20 years of experience in investment banking, the majority focused on the energy sector. Over the course of his career, he's been involved in over $5 billion of advisory and capital market transactions as a lead bank. More recently, Mr. D'Amico has been on the leading edge of the minerals and royalty space, where he has obtained an extensive knowledge base, executed several transactions, and helped the sector gain exposure within the investment community. Mr. D'Amico holds a bachelor's degree in finance from the University of Maryland and an MBA from George Washington University. So now I will turn the controls over to Ralph, and Chad's going to open with a little introduction about PHX Minerals. Go ahead, guys.
Dan, thank you. Good morning. Appreciate everyone joining us today. Before we get into the specifics of PHX Minerals, I think it's important to put the whole discussion in context by giving you a quick 2-minute flyover of the history of PHX. It was originally formed back in the 30s and 40s with farmers contributing their minerals to a co-op over decades that collected up to about 250,000 net mineral acres around the country. Panhandle Oil and Gas became a C Corp, converted it from a co-op to a C Corp. In the 70s, took it public as a C Corp. In the late 70s, it's been public since then. For decades, the management's philosophy was to basically manage and harvest from the 250,000 net mineral acre base that they owned and had. And that main strategy was to sit back and wait for operators. This was back before horizontal drilling, when vertical wells were the choice of the day, or the technology of the day. Companies, the Exxon Mobils and the Chevrons of the world, would come and propose wells on Panhandle Oil and Gas's minerals. Panhandle would look at the economics of that well and decide whether to participate as a non-op working interest owner or lease their minerals to the driller and just get a royalty revenue. Thus, today we have an interest in several thousand wellbores as a non-op working interest through that strategy that I just described, as well as an interest in several thousand wellbores that are just royalty revenue streams. When I took over in January, fall of 2019, introduced a strategy to the board that they accepted my strategy. I became full-time CEO and president in January of 20. And at that point, we launched this new strategy. Part of the new strategy that I felt like I needed to execute on pretty quickly was make Panhandle oil and gas relevant. It had a relatively, I don't want to be derogatory, but just it was a confused message. The market didn't understand Panhandle strategy. So I wanted to really become relevant and clarify the overall strategy. We changed the name to PHX Minerals to better align the strategy with the name of the company, appear to be a little bit more aggressive and relevant to the marketplace. Changed the name. I brought on a whole new management team, appointed Ralph, CFO, brought in a whole new technical team. I introduced all new processes and procedures that I had used at Range Resources in evaluating oil and gas assets. So thus we have a whole new culture, performance culture, relatively new board overall. For the size company that we are, we have a very impressive board, I might add. So today our strategy is purely mineral only strategy. We're slowly high grading our asset base by divesting of all the old non-op working interest wellbores and redeploying the proceeds into our mineral acquisition program. So with that, that's how we got to where we are today. Ralph, do you want to add anything to that before we get into the slide deck?
No, I think you covered it. It's been, I think the only thing I would add, it's, when we employed this strategy a little over 2 years ago, right? It was unproven, right? And 2.5 years later, I think if you look through our financials and you look through the returns that we've generated, we have effectively proved out what was a brand new strategy that we set forth from scratch effectively a little less than 2.5 years ago. So we continue to be excited. We're not done yet. And we're going to continue to grow this thing. Yeah.
And as you'll see, as we get into the slide deck, 2 years ago, I never expected, I knew we had a steep hill to climb. We're a small company. We're still too small today. We need to grow, and we're pedaling as fast as we can to grow the company. But 2 years ago, I really didn't expect that we would have quite the success that we've had to date, and the momentum that we've built, as I said, to be relevant in the marketplace. Our name now is out there. The deal flow is coming to us. We're not going out to find the deals. People are calling us up and submitting mineral opportunities in the core areas where we're focused, and we'll talk about that. But I never dreamed that we would have the success that we would have today. And like any CEO of any public company, I think our stock's undervalued, and we can kind of generally show you why we think that. So Ralph, let's get into the slide deck.
Okay.
So again, I come from an acquisition background while at Range. The 4 billion plus of deals that I did started from the ground up with technical evaluation. So I brought on this team. We have great geologists, great reservoir engineers. We use big data, statistical data to evaluate properties and make sure we're evaluating the reserves in the ground in a very conservative fashion. You'll see as we get into the financials, the progress we've made in terms of our EBITDA and what that translates into in terms of the multiple at what our stock price is today. We think there's a lot of upside there. We think there's going to continue to be this whole mineral asset class continues to gain traction from a public perspective as well as private, but from a public perspective. And we think there's going to continue to be this mineral consolidation in all of the basins. The two basins we're focused on, we'll talk about, but we think from the size of the company we are, these two basins serve us well. We're not in the Permian. We won't be in the Permian. The dollar per acre prices out there are too frothy for us, and we can't get the bang for our buck. So we focused on a couple of other basins. And again, I think the team that I pulled together for PHX is a really seasoned team. We really have built some momentum quickly for the company, and we're creating an additional proven track record at PHX in terms of successfully executing on this acquisition strategy. Ralph, you want to take this?
Yeah, you're in, yeah, the only thing I would add also in terms of the peer group, I think as we walk you guys through this, it's important to note that we're a little bit different than the other public minerals guys. The other public minerals guys are focused on return of capital, where they're distributing 80 to 90% of their free cash flow. We generate a pretty similar free cash flow yield to what they do. But the difference is they're distributing that 80 to 90% back in the form of a dividend. We are distributing about 10% of our free cash flow, right? So our yield is about 2.5%, more or less. We just increased the dividend last week, actually. We announced it. And what we're doing is redeploying all of that cash flow into high return acquisitions, and we'll walk you through that. But it's a little bit of a different strategy. Given our size, we think we can generate much better returns in the long run by pursuing that strategy than by just harvesting production and distributing such a high portion of it back to the shareholders. We'll continue to grow the dividend, right? But as a percentage of total free cash flow, the strategy is not to get up to that 80 to 90% that the peer group uses. Chad, we're on page 5, the company overview. If you wanna see that on the screen, cover that a little bit.
Yeah, so you want to walk through the overview dashboard real quick, Ralph?
Sure. Sure. So, yeah, so if you look at that, if you look at this, right, we're generating right now, this last quarter that ended March 31st, we did just shy of $6 million of EBITDA. So if you annualize that, you know, you're at roughly a $24-25 million annual EBITDA basis, and where the stock's trading today, you know, our market cap is roughly 120 or so. You add another 25 of debt to that, so our enterprise value is about 150. And you know, if you divide that by the by your annualized cash flow, you know, we're trading in the 5 to 6 multiple range, which is fairly, you know, which is a pretty steep discount to where the peer group currently trades at, you know, roughly at about 10 plus times. And again, you know, what we're showing here is, if you look at the inventory, and we'll get into more detail on this, but the inventory of wells in progress and permits and activity on our acreage, we think we're providing significantly more production upside than the peer group. And ultimately that just generates increasing cash flow, even if commodity prices stay where they are. If you look on the top right of the page, we're really focused on gas. We think that gas is the key transition fuel to a cleaner, you know, energy environment. That's something that's pretty topical today. And if you look at the majority of where our production is coming from, it's really the Mid-Continent, in the Scoop, the Stack, and in the Fayetteville. I'm sorry, not the Fayetteville, and the Haynesville.
Haynesville, yeah.
Which are predominantly gassy basins as well. Chad talked about the working interest versus the royalty interest. If you look at our reserves as of 3/31, by volume, we're 55% royalties and 45% working interest. But when you really look at it on a PV10 basis, because remember that minerals have, or royalties have, a much higher cash flow margin than working interests do. We're about 2/3 royalties and 1/3 working interest. Page 6 gives you the mineral position. This is sort of a busy page, but it shows you the where most of our properties are located. And really what you should focus on here, there's a lot of noise here. The focus really is the Haynesville and the Scoop Stack, which are highlighted there on the map. That's really the growth area. That's where we spent virtually 100% of our acquisition capital over the last 2.5 years or so. And then if you look on the top right of the page, you'll see that out of the 250,000 net mineral acres that we have, over 2/3 of that are open, unleased minerals. And those are really not core to our position. Those are going to be in New Mexico. It's going to be a lot of it in Western Oklahoma. And there's upside there. But there is, it's more longer term, sort of greater than 5 years, 10 years in terms of the development potential of those minerals. And we're really focused on high grading the asset base. So the thought process is sell the working interest, sell the open minerals here, and it will be a process, not an event. What you'll see over the last 2 years is we keep taking little steps, right? Every quarter we sell a little bit more as we get what we think is a decent price for those assets, and we'll redeploy that capital. So, if you think about a year from now, this map is going to change drastically, where the New Mexico and the Western Oklahoma will likely shrink, and you're going to see a lot more of the Scoop, Stack, and Haynesville filled in. Anything else you want to cover on that page, Chad?
Yeah, let me just, so when we first started this strategy, when we embarked on this mineral acquisition strategy, one of the things I was telling our investors, our shareholders, was that at that time in January of 20 and mainly in the year 2020, the existing asset base of PHX was not the future of the company. And I think the market was a bit confused because they had all this working interest, all this royalty revenue, and no real story around year over year in the coming years how the company was going to grow its cash flow and its asset base. And that was my theme right away, was this company is too small to be housing or inventorying 170,000 net mineral acres that are not producing. Just doesn't make sense. It's confusing. It weighs down the story. You should always be willing to high grade your asset base. And so we quickly began focusing on my history and our technical team's history in the Scoop, Stack, and the Haynesville led us really to focus on those basins. Scoop Stack's a bit of an underappreciated, got some bad headline news back in 2018 and 2019, but we really understand that basin. We really understand, especially the Scoop, the rock quality. There's a narrow fairway that you should focus on. So we focused on the Scoop, Stack, and the Haynesville, and we're slowly divesting of these minerals that are out on the margins of these basins and redeploying the cash proceeds into the Scoop, Stack, and the Haynesville into minerals that have a clear line of sight development under reputable operators. So you'll see just over the last couple of quarters, our royalty volumes are all of a sudden growing, and we're anticipating just in the near term, next few quarters, the royalty volumes continuing to grow at a very similar pace as these minerals we've acquired are being drilled and developed and put into production by the operators that we're under.
Yep. Next page, just a snapshot of the reserve value. That we look at this as sort of a proxy for net asset value, and I think it's important to understand the terminology on this page, right? Because I think when you look at a typical oil and gas company, an operator, right, their definition of PUDs or proved undeveloped, right, are wells that they're going to drill over the next 5 years, right? That's what the SEC requires as, it's an offset location and it has to be in their drilling program. Because we don't operate, we just own the minerals, right? We don't have the ability to call anything a PUD unless there's already a permit on it. So when you look at PUDs for us, it is literally a permit or a well that's already been spud, or it's a DUC. It's, basically there's enough activity on there for the SEC to be comfortable that a well is going to be brought online. But we don't control the drilling inventory, right? So when you look at probables for us, right, when you think about an oil and gas probable, inherently most people associate higher risk with it. For us, it's not really a quality issue. It's a timing issue. Because we don't know when the operator is going to drill those leases, we call them probables. So it's purely a timing. We think it's a very high quality acreage position. And quite frankly, what you see as probables for us are almost 100% PUDs on the books of the operators that are leasing those minerals from us. So they're effectively PUDs on Comstocks, on Aethons, on Chesapeake's, on Continental's books. But because we don't know when exactly they're going to drill it, we call them probables. But we think there's real value there. And so if you look at on a per share basis, we try to back out the debt and get to, give a proxy of what the NAV of the reserves is on the SEC as strip case, and then some sensitivity around $100 oil and $6 gas flat. And you can see that, the 2P, which includes the probables, right, which again are PUDs on somebody else's books, you're anywhere from $7 a share to $13.50 a share. So that's, when we talk about being undervalued, or our view of being undervalued, is not just in a multiple standpoint, but also on a reserve NAV standpoint as well.
And let me add to that. So the probable category is purely royalty interests under future drilling wells. There's no working interest involved there whatsoever. So all of that probable value is high majority of it, 90% of it, is from acquisitions that we've done since January of 2020, really since September of 2020. That was the first acquisition we actually did after I'd become CEO. So under strip, that probable, that 154 million is all royalty interest under future wells to be drilled in the cores of these basins, high rock quality, hundreds of wells producing in and around our minerals. So we have a good statistical database to determine what the wells are going to produce and the ultimate reserves over the life of that well. So those probables are real value.
Yeah, that's a very good point, Chad. And just as an FYI to everybody, we actually wrote off every single undeveloped working interest location that we had. We wrote that off and impaired it in the fall of 2019. So it's off the books. So whenever anybody proposes a well on us, we say no, thank you. And we go non-consent, or we actually lease the minerals, release the minerals at a lower depth or whatever it may be to that operator. But there is 0% of the upside is associated with working interest on this.
And one other, it looks like somebody's posed a question here. One of the other things about these probables, as a mineral owner, there's no governing agreement between the mineral owner and the operator that allows us to dictate when or how they drill a well. And they won't tell us. We have no idea. We watch all of the public data, especially in Oklahoma and in Texas at the Railroad Commission. You can watch and see permits. There's pre-permitting paperwork documents that have to be filed. Then the permit to get drilled, that a Railroad Commission approves it. And then the permit allows the operator to drill that well. But we have no say on that. We don't know. They don't tell us. They're not in any way legally obligated to inform us of anything about the well when it's drilled on our minerals.
Yeah. Next page, we just try to show a breakout of our inventory.
I'm sorry. Go back just a second.
Sure.
So discuss the difference real quick between SEC pricing and strip pricing.
Yeah, that's good. That's a good point. So SEC is always backwards looking. So, they take an average price over the period that you're measuring, right? And it's not forward looking. So, what we did here, and you can see it on the footnotes, what the prices were, and we ran this for the strip and for the SEC. So right now they're pretty close, but if you look back a year, because the SEC was using, requires you to use a historical price, it's always going to undercount in an up market. So the strip is a bad predictor of oil and gas prices, as we all know, but it's the closest thing that we have. So that's really why we try to look at that as you know, the closest guide to true NAV and not SEC pricing.
And again, to underscore, Ralph said it, that when you look at strip pricing, again, it's a horrible predictor of future prices, but it's the best we've got. When you look at our 2P value, I think it's a fair predictor of kind of analysis of what our true NAV is. It's net of debt. And it at today's current prices, and there's an extreme backwardation in the curve. You can see the kind of the low side, we're around $8 a share. And if we're in a long-term environment over the next 8 to 10 years of $100 oil and $6 gas, you can see relatively pretty decent upside under that price scenario. So
Yep.
just
inventory by basin. I think we talked about this. I mean, the gist of it is you can see on the far right, top right, that all the upside or the majority of the upside is going to be in the Scoop, the Haynesville, and to a lesser extent, the Stack, which are the areas that we've talked about. You know, we have, if you look at, I mean, we have years and years of inventory left in terms of drilling locations.
And again, these when you look at these, I just want to stress it that especially the probables, but the possibles too. They're on a map. The geologist has done his work on the geology on specifically each of these locations. There is a stick on a map. There's offset production. So we have a pretty decent a predictor of decline curve analysis and what the ultimate reserves of the well would be. So these are all real live locations.
Yep. The next two pages are pretty similar. They're just different time frames. We'll just cover this last quarter. Again, I talked about the activity in our minerals. This is how we like to look at it. So starting from the left, right, what we want to make sure is that every time a well comes online and becomes a producing well, right, is it repeatable? Is there the next set of wells, the probables that are being permitted and spud, that creates this inventory that we can continue to show activity on the minerals and you know, and which inevitably leads to higher production and higher cash flow. So if you start on the left, on December 31st, which was the end of our fiscal first quarter, you know, we had 65 gross wells that were wells in progress, so permits, DUCs, etc. We actually converted to PDP during the quarter 108 gross wells. And you may be asking yourself, how did you convert more wells than you had in inventory? And the answer is the market's moving so quickly, or the operators are trying to get production on so quickly that you actually had wells that were that were probables that went all the way to PDP during the quarter. So in this market, you didn't even have enough time for it to, you know, show up from a probable to a permit the next quarter and then to a PDP the following quarter, just the speed in which the market's moving. There were an additional 144 gross wells that were probables or possibles that became wells in progress. They were permitted or spud. You can see then the wells that we acquired. We keep divesting some legacy wells. These are going to generally be old vertical wells. And we finished the quarter in March 31st with effectively twice as much inventory of wells in progress as we started on a gross basis as we started the quarter with. And you can see on the bottom of the page, the majority of this is in the Scoop and in the Haynesville. Just going to the acquisition page, I think we touched on this a little bit. We've closed on about $55 million worth of acquisitions since September of 2020. And we have another 10 or so under PSA that should be closing here in the near term. You can see where it's been. The vast majority of it has been in the Haynesville, about 36 million or so of the 55 and 18 million, the rest in the Scoop. We have a very targeted, very detailed a view on the quality of the rock, and Chet can talk about how important that is here in a second. And then the typical acquisition that we look for is, and again, this is different from the other public minerals guys who tend to buy deals that are predominantly producing, majority PDP because they're trying to make it accretive on immediately to the dividend. We take a little bit of a different view, which I think gives us a competitive advantage and allows us to generate a higher rate of return. We take a little bit more effectively timing risk because we don't control when the well gets drilled. But if we look at a deal that by value is a third production, a third wells in progress, which are anywhere from permits to DUCs and should be coming online between tomorrow and 6 months from now, and the rest of it are, to us, probables, but they're really PUDs in the context of the operator, right? So they come online, within the next 18 months or so, right? We can generate rates of return that are in excess of 20%, which again is, we think higher than what other folks are realizing buying predominantly PDP at 10 to 12% discount rates. You want to touch on just the process on evaluating these, Chad?
Yeah, sure. So as I said, when you're evaluating the economics of buying minerals, it's really no different than an ExxonMobil who goes through all the technical analysis to decide whether to drill a well or not. And it starts with the geology and the rock, the reservoir pressures, the zone itself, the landing in the zone, the frac design. That's one of the things that's made the Haynesville so successful over the last couple of years is improving on the frac design and the amount of sand and water they're putting away in these fracs. But because we're a mineral owner, we're one rung up the value stack. We don't have any cost. We're not obligated to spend any money or capital expenditures associated with drilling the well. We get a free royalty revenue off the top, but we still have to evaluate what we're willing to pay for the minerals to give us the discounted value of the future cash flow stream on that free royalty revenue. So we start with the rock. We have a reservoir engineer who studies all the wells in the area where we're buying, the pressures, the decline curves, and the ultimate reserves, and plugs it into her reserve economic program, and we come up with a discounted cash flow value. And we're buying these things in the 20+% rates of return and a really attractive multiple of invested capital above 3, which we think we're making really good value for our shareholders at those type of economics.
Yep. Next 2 pages just very quickly show where the majority of the acquisitions have been in the SCOOP and in the Haynesville. In the SCOOP, you can see what we're really targeting is the springboard plays underneath Continental Resources, to those of you that follow them. In particular, Springboard 3, which you can see towards the bottom of the graph, is where the vast majority of the last 18 months where we have focused on, and we'll talk a little bit more about that here in a minute.
Hey, Ralph, go back just a second.
Sure.
So early in the play, in the SCOOP stack play, Springboard 1 and 2 was an area that Continental focused on, and they built up a really blocky leasehold position. And this was back beginning in 2018 and 19. And at one point they had like 10 rigs running in that blue outline area where it says 1 and 2. And they were drilling these wells in each section, what we call mowing the grass. They had 2 or 3 rigs running in each section, and they were drilling 6 or 8 wells, one lateral after another next to each other in each section, moving across that blue outline area back and forth. And we just call it mowing the grass. And they ultimately drilled 140 or 150 wells over about an 18-month period. So we're seeing down in Springboard 3, we're seeing pre-permitting activity that suggests they're going to do the same thing. That you have to have gathering lines, pad sites. You got to get all the different permits to do all of that. And we see the pre-permitting documentation at the Oklahoma Corporation Commission that suggests they're about to do the same thing in 3, and we're really excited because we have a really good mineral position down there, and it's going to translate probably beginning in the second half of 23, going into 24, into some really nice royalty volumes for us.
Yeah, and one of the things also, if you guys have looked at our board, Chad talked about the quality of the board. A guy named Glenn Brown, who is now retired from Continental, he was their VP of geology, effectively one of the guys that discovered these plays, is on our board. And when we work up this area, right, he is one of the guys that approves our acquisitions, right? And so I think it's pretty nice, his opinion and his vision of this play, I think, are pretty important and give us a lot of confidence in terms of what we're doing here. Next page, you can see the Haynesville. Again, we tend to focus on, we're on the Texas side, on the Harrison-Panola border, close to Louisiana, and then Caddo and DeSoto parishes, where there's a majority of the development activity on the Louisiana side. And, and then to the south in St. Augustine, where you're seeing a lot of Aethon development as well. But we try to be very choosy with who the operators are. We want to make sure that they're good stewards of the minerals, right? Because ultimately they're the ones operating that well site. And we tend to favor guys like 2 private companies called Blue Dome and Aethon. Aethon's probably one of the largest companies operating there. And then on the public side, and Trinity, which is really the oil and gas arm of NextEra. And then on the public side, we like to be under guys like Comstock, Southwestern, and Chesapeake in there as well. And we try to focus where those guys are really operating rigs, to make sure, again, it ensures that there is a continuous development of the minerals that we own.
And let me stress, just from a macro perspective, this is dry gas. It's close to the Gulf Coast for the LNG projects that are down there now, and the new ones in the future that are planned. And we're a big believer in natural gas for the future. So Ralph mentioned that, but we started this in 2019. That was one of the first things I discussed with the board, is getting into gas. I'd love to get into the Marcellus. Obviously, that's my background at Range. But we're a big believer in natural gas for the future, for the next 25 or 30 years. So that's one of the reasons we got into the Haynesville.
Yeah, it's interesting. When Chad became CEO, we did not own even 1 mineral acre in the Haynesville. So this is an area that we targeted once he became CEO, and we've created this position from scratch. And we've been lucky to be able to put maybe lucky isn't the right word, but we've been very fortunate to be able to create a position, right, from scratch over the last 2 years that looks like this. The next couple of slides are just it's a bit repetitive on some of the stuff that we've already talked about, so I'll kind of run over it. I'll go through it fairly quickly. Again, you can see the scoop position here, and who the top operators are in the area. And we look at top operators, not necessarily on existing production, but who are the guys who are permitting and drilling wells. So on our position in the scoop, these are the folks that effectively have the most rigs currently present in the play. Springboard 3, this is just a little bit more detail on what we focused on in that acquisition play. And I think what's interesting about this page is if you look at the recent well results, the Continental's Bowery 116 well, which we own, what do we own on that? We own about 0.5% of that well. But what Continental has effectively said, it is the highest IP rate in the recorded history of Oklahoma horizontal well drilling. So that's pretty, that's pretty reassuring that they're going to continue to drill. You can see what they're doing now is they're actually drilling one well to hold to hold operatorship in some of these sections, and then they're going to go back and, as Chad said, mow the grass. But this is an area that has, I mean, what's the pay zone is what, Chad, 400 feet?
Well, and that's so in any area, you look at the gross thickness of the pay. For instance, the Marcellus, the gross thickness of the Marcellus in Southwest PA on the range is about 150 feet thick. The net pay, the pay that gives up the reserves, is probably 90 feet. So there's a net to gross ratio that you determine. Here, the gross thickness is about 700 to 750 feet thick, and the net's about 650 of it. So the net to gross here is very high. And so the rock quality, the resource in place, it's some of the best rock in the country that we've discussed with Glenn Brown, who again was a geologist at Continental. He's seen cores from wells right in this blue outline area, and he said it's some of the best rock he's ever seen. So when you talk about the number of wells, the density spacing, one of the reasons the Scoop Stack got bad headline back in 2017 and 18 is Devon and Marathon. They were talking about drilling 10, 12 wells per section up in Blaine County, which is well north of here, a couple of counties north of here. They drill their wells and realize instead of 10 or 12 wells per section, they were only going to be able to drill 5 or 6 wells per section. So it gave kind of off the bat, so to speak, some bad headlines around this particular area. But down here with this resource, the thickness and the quality of the rock and the resource in place, the amount of wells that are going to be able to be drilled here is as yet undetermined. It could be 7 or 8 wells in the Woodford, 4 or 5 in the Sycamore. There may be 3 or 4 Woodford sections to be developed separately. So we're really excited about the future of this area. A lot of upside.
Yeah, and here the hydrocarbon mix is approximately 1/3 gas, 1/3 oil, and 1/3 natural gas liquids. Haynesville, same map. I think what I would actually point out here is 2 things on here. The top right, which is, again, we started 2.5 years ago, we had 0 acres here. Today, we've put together a position without really buying any meaningful amounts of PDP. This last quarter, the Haynesville was 29% of our total production, which I think is pretty impressive. On the bottom right map, what you also see is the dotted line. That area also has the Bossier present, and that to us is upside. When we evaluate and we underwrite acquisitions here, we assign 0 value to the Bossier play, but that could be a second area that the folks are starting to look at and provide some additional upside for us in the future. This is again a more detailed view of the northern Haynesville. This is Caddo Parish, and again, you can kind of see where we buy is typically where there is a significant amount of activity, those wells in progress that we talked about. And we're also trying to target high interest wells. What we found is that if you really understand the rock, if you think about a roulette table, there's no need to really put a chip in every number, on every number. So here what we're doing is we understand the rock, and where we understand the rock, we want to buy as much of that well as possible. So a lot of the acquisitions that we make are on sections that we already own minerals. And what we're really trying to do is increase our net interest in those wells. And you can see on the bottom left as examples, there's some units where we're owning 3 to 4% of that unit. So that's also a little bit different view on how to deploy capital that I think has served us well. You want to talk a little bit about these 2 pages? I don't know if anybody has any interest on just LNG and why the Haynesville, but we have a couple slides that to talk about it. Maybe we'll just push forward and we can go back during Q&A. From a financial standpoint, just to get into the financials, again, the key date here is if you look back at Q4 of 2019 and Q1 of 2020, that's what Chad and I inherited when we became the management team. The company was doing, 2/3 of the company's cash flow was coming from working interest, right, on a steep decline, and there wasn't enough working interest opportunities for them to redeploy cash flow. So what you see was a declining EBITDA. Then COVID hit, right, and it was a double whammy. And we were effectively at the time, part of the reason why Chad became CEO and deployed the new strategy was we were not generating, the old Panhandle Oil and Gas was not generating any return on capital employed. And you fast forward to today, even with what we call our COVID hedges that the banks made us put on back in the height of COVID, we're already generating mid-teens return on capital employed. And as those hedges roll off, you should see that number increase drastically in this price environment. Balance sheet again, one of the things, if you look on the top left, one of the things that we had to do through COVID was navigate what was a slightly stressed balance sheet. We did that successfully. We never breached any covenants. It was hard work, but we got very, very close to the edge. But we've transitioned away from our old bank, which was Bank of Oklahoma. We're now with a bank out of what are they? McKinney, Texas, called Independent Financial, and they're a really good partner for us. They're providing us with ample liquidity. We continue to manage all of our debt metrics. We want to be in the low ones in terms of debt to trailing EBITDA. But with our growth rate, if you look at forward-looking EBITDA, we're well below 1 on a forward-looking basis. And we're going through our spring redetermination process as we speak. We should be able to put out a press release at some point towards the end of next week with what the new borrowing base is. I mentioned on the earnings call that it should be materially higher from where it currently is, and that's really not pricing. That's all predicated on higher reserves that we've created over time, which is always nice to see. The banks are still being very conservative with the price deck that they use, but we're going to get a pretty nice ramp up based upon all the additional reserves that we've gotten. Let's just finish on hedges. Yes, on the bottom of the page, you'll see that we still have some gas hedges at $3. Again, that's the legacy COVID hedges that we had in place. What we typically like to do as a strategy, we have really two things that move the needle for us, right? One's commodity prices and two is volumes, all those new wells coming online. So what we try to do in this pricing environment is lock in the returns of the PDP, right? And we try to get up to 75% of the PDP hedged over the next 12 months. And then what that translates to, based upon our growth rate and the wells coming online, it really translates into being about 50% hedged on total volumes over time. And you can see, over the last couple months, what we've done in terms of hedges. We're big believers in this natural gas environment of using costless collars. You can effectively have a pretty wide collar the way the market volatility is today, and we've done some 6x10s all the way up to 6x1450 on a costless basis. And on oil, we actually think there's more upside on gas than on oil, and more downside potential on oil than gas. So on oil, we've actually done a little bit more swapping of those volumes. Again, just because I think we're a little bit less optimistic on oil, but it's also a much smaller piece of our total hydrocarbon stream and cash flow, and it's less than 15%. Um,
And it'll become less and less as we
Yeah.
move forward.
yeah. So Dan, that's really our prepared remarks. If you wanted to do Q&A, I know
Yeah.
tend to be a little, we tend to talk a lot, so
That's fine.
probably went long, but we're happy to do Q&A.
Yeah, you answered a lot of questions I had, but no, you guys did a great job. And I agree with you. I truly believe, and I do a weekly podcast, and I believe there's been a significant structural change in the U.S. gas market. And I kind of want to get into that for a minute. Recently, Raymond James, just last week, they raised their U.S. natural gas price forecast to $9 for the second half of this year, and $9 per MMBTU for the third quarter. First of all, what price are you guys using when you value the mineral? Are you using like $6 or something?
We do in the economics to determine that discounted cash flow stream. We typically just use the current strip, whatever the near-term strip is. And again, we know that strip's not an accurate predictor of future prices, but it's the best thing we've got out there. And then we'll typically, when we close, whatever PDP value we put on that, we'll lock in some hedges, costless collar hedges on that PDP production.
Yeah, when I was at Hess, I worked on acquisitions for the last 3 years. I had a team of MBA. We were evaluating, publicly traded companies for takeover targets. And I say we used to say our cutoff was if we could buy a company for less than 6 times cash flow, that was a target for us. I can give you a list a mile long now of companies trading for 3 or 4 times cash flow. It's insane how cheap some of these companies are. I can't believe there's not more, takeover activity.
Yeah, I agree. Totally.
One thing I want to talk about, I think, and one reason Raymond James has this bullish outlook on gas, and so do I, is you look at a lot of these big basins, with Marcellus Utica, they're kind of infrastructure and pipeline limited. I mean, there's just not much upside they can have to get it out of that basin now, where the Haynesville has very good access. Actually, it's located close to Henry Hub, but also located not too far from the big LNG export facilities. What are your thoughts on that?
There's probably the rig activity, the number of wells being drilled and completed annually suggests that maybe this time next year we might start moving into some sort of pipeline's not going to be full, but there's going to be some capacity issues. And I've already seen a couple of the midstream companies announce capital expenditures to add compression on some of their bigger lines to add capacity. And that's relatively inexpensive and relatively quick. Half a BCF to 3/4 of a BCF of additional takeaway capacity. And I just think you'll, on the heels of that, and with these new announced LNG liquefaction plants, FIDs coming up on new LNG plants down the Gulf Coast, you're going to see more pipeline, and it's relatively short haul stuff from the Haynesville field down to those areas. So it's relatively inexpensive and quick to get done. Whereas EQT's, their Mountain Valley project out of the Appalachia, they've been working on that for 7 years, and it's gone from an original investment of $2 billion to $6 billion. They got problems up there. You're right, takeaway. But I think the Haynesville, we like it for all those reasons.
Yeah, I mean, I just can't see with the government we have now, them ever allowing more pipelines to be built into the Northeast. Now, I will tell you that the people in New England are going to be paying some outrageous utility bills if they don't put pressure on their administration to, allow pipelines to run through New York. And it's on the liquid side too. If they're cut off from, diesel coming out of Russia, they got problems up there, man.
Yeah,
Serious problems.
2 years ago during the polar vortex, they were paying $100 an MMBTU.
Yeah. Hey, Chad, when I was at Hess, we sold one winter gas into the New York City gate for $60 an MMBTU. $60. I actually thought they put the decimal point in the wrong place. I said, this can't be right. I called our marketing guy and say, yep, we were able to get some gas up there. So now tell us, how do the operators, I know they got a lot of their gas that's dedicated to pipelines, so they can't really move that around. But then if they have undedicated gas, like if Comstock has undedicated gas, they probably have, 12 or 14 different pipelines or something they can get their gas to, can't they?
Yeah. So any of the pipelines that are in the Haynesville, there's several large interregional long haul pipes, and you can sell at any. There's several different big collection points on those pipes where there's actual an index, a set price at that meter station on that pipeline, and you can sell to big marketers. BP is one of the largest daily marketers of gas in the U.S. They market, I think, 5 BCF a day. Utility companies, whether it's a state utility in Louisiana or a utility in Florida who has capacity on that line. So if you don't have capacity and you have some free gas available to sell, you can just sell into one of those meter stations, and there's plenty of liquidity and price transparency to sell into. So it's no problem.
I think Comstock might have gotten some like $50 gas sales during the Winter Storm Uri. I think they had not real big volumes, but I think they sold some pretty, because I know one quarter they had a big spike in their realized gas price.
We heard about that, yes.
Yeah, I don't think they wanted to brag about it too much, but
it wasn't quite that in the mid-continent, but some of the stuff we sold during that was probably in the $13 to $15 range. Ralph, did we get anything higher than that?
No, I think that was it, but we got a fair amount of it. I mean, it more than offset we had a small number of wells that got shut in, but I mean, that differential that we got for that time more than made up for it.
Hey, let's talk in Scoop. What kind of prices are you getting up there for gas, and especially, and what about NGLs? Because I know you produce a lot of NGLs up there too.
So yeah, and especially in the Springboard 3. So gas prices are typically, it's not that bad. Basis differential on any pipeline in Oklahoma is around anywhere from 20 cents to 40 cents. So it's really not that bad. At one point last summer, it blew out to like 80 cents, but there were some backhaul issues from Midland up into Panhandle Eastern, up in the Texas Panhandle, but that was very short-lived. Its historical average is 20 to 40 cents, depending upon the seasonality. For Springboard 3, the gas is about 1,400 to 1,500.
Wow.
You gas. So when it's MMBTU adjusted, we're getting 60%, call it 60% more because of the liquids coming out of that gas.
Yeah, and one thing to explain to some of our members, they're not really sure, how the hedges work. You get, correct me if I'm wrong, but do you sell your own gas, or you just get whatever price the operator's taking?
Yeah, no, mineral owners are just subject to whatever the operators sell.
Okay. So you can't take your gas in kind or anything.
No.
Okay. And tell them, like, the gas is sold, all gas is sold, or all production is sold in the physical market, and the hedges are settled against whatever index you hedged with, correct?
Ralph?
Yeah. So these are not physical hedges. These are all.
Yeah, they're just paper hedges, right?
They're paper hedges, because again, we don't control. Again, if the operator has pipeline optionality, right? We that's what makes it difficult for a mineral owner to hedge basis differentials, because you don't know where the operator is actually going to sell into. They have to sell on the same basis that they sell their gas. They have to sell our gas, right?
Okay, good. So you don't have to. You just hope they're honest, right? And give you.
Well, they have to be, because we see what they're selling. We see everything on an 8/8 basis, and then.
Oh, okay, good.
So there is. It would take literally about 5 seconds for us to figure out if they were selling our gas at a different price than their own gas. But yeah, so because of that, for gas example, we hedge. All of our hedges are based on Henry Hub.
Okay. Let me ask you this: Are your hedges, are they required by your debt holders, and if so, how much percentage do you have to hedge?
So yeah, the credit agreement requires us to hedge 45% of our PDP for oil and 45% of our PDP for gas in months 1 through 12.
But none of the NGLs. You don't have to hedge NGLs.
No, we do not hedge NGLs, because again,
good.
It's very difficult to predict what that NGL stream is going to look like, right?
Right.
Be more ethane, more propane, or whatever it is. Interestingly enough, Continental, they don't strip out NGLs. They basically sell rich gas. So
Oh,
as
good.
I said,
Yeah.
right, they're selling 1,400, 1,500 BTU, and we're getting paid.
They have to take enough out to meet pipeline quality specs. You can't, there's a certain
Yeah.
amount to take out, but for the most part, they leave what they can in the stream.
Yeah.
Yeah.
And then you get paid higher price for that, which is why I just issued a report on Continental, and they report their gas and NGLs on a combined basis, so you can't really see the split. But their combined gas price is much higher than like what you expect. I mean,
Well,
even last quarter was $6 or $7. So
yeah,
but-
I'm sure most operators are doing that, because when you look at where ethane prices are today, on a gas price equivalent basis, it's like $9.
yeah.
So
Well, I know we have several members here that are on the call here today. I'm sure they own Continental because they're unhedged. They have a little bit of their gas hedge, but I think all their oil liquids are unhedged. And I will tell you, I've followed Continental for about 10 years, and you guys say their mow the grass strategy. When Harold sees these kind of well level economics, I can guarantee you the lawnmowers will be out there because these are 100% rate of return wells. I can't believe how some of these. One of our little Canadian companies reported yesterday, and their wells are paying out in 3 or 4 months. They're putting horizontal wells into some of these old fields. They're not fracking them, just short horizontals and stuff. And these wells are paying out in 3 or 4 months now, which means you're getting like 200, 300% rate of returns on your investment. It's unbelievable. So, and I'm sure these Comstock wells coming on at 20 million a day, man, oh man, I don't know what those wells, those wells cost maybe what, 8 or 9 million, those completed Haynesville wells.
yeah, but
they're making like $2 million a month.
It started, Aethon was the one that really made this play what it is today. They really started experimenting with the frac intensities, the amount of the pounds of water and sand they were putting away, the spacing between each perf. So they were the ones that started producing creating these 20 million plus a day wells, 25 BCF EUR wells, and everybody else started copying their frac design. So yeah, they were the ones. But what they're doing now, they do these big fracs, and they test run. They do a couple of days test, and then they'll start, when they actually put it into sales, they'll choke it back for pressure maintenance. And they'll ultimately get more reserves, and the PV the discounted value of that stream is much more valuable than just blowing the well out and letting it just, you kind of blow the pressure of the zone out, and you end up losing a lot of the ultimate reserves. But
I understand.
So they're all going to that pressure maintenance as well.
Well, all I know is the owner of the Dallas Cowboys is going to make a fortune on Comstock.
Yeah, he is.
And he got that thing for nothing, hardly. Anyway, okay. In your core areas, do you have adequate infrastructure and pipeline access? Because some of the operators are telling us they're having trouble getting enough tubulars. Yeah. So there's 2 questions, I guess. Are you hearing from the operator they're having trouble with getting, frac sand or tubulars? And then also in both of these areas that are your main, you have adequate pipeline access, right?
Well, again, we don't sell, so we don't know what pipelines these operators are going to. And we called them and asked them, but they won't tell us. So
yeah, but those basins they don't seem to have limited pipeline access at this point.
No.
Okay,
I will say there was a reported problem on Aethon's gathering system that collects the gas in their fields and then takes it to the long haul regional pipelines. But it was a compressor station that blew up, and it wasn't a pipeline capacity issue. It was just a machine issue. They had to fix it. So their production dropped down for about 3 or 4 weeks while we're trying to get that compressor station fixed. But
stuff happens in the oil field.
Yeah.
We know that.
We don't hear any real material restrictions at all about takeaway in the Haynesville.
On the materials, Dan, I mean, I will say, clearly on the non-op working interest that we have, we see the LOE. I mean, it's subject to inflation and,
Yeah.
just like everybody else, right? And part of the reason why we like being a mineral company and we're trying to get to be 100% as quickly as possible. But I will say your point's a good one. The question's a very good one. And who the operator is part of our underwriting process.
Oh yeah, that's a big deal.
Acquisitions,
Yeah.
right?
Yeah,
It is a big deal. And what we don't want to do is be under, we want to be underneath, guys like Continental who basically have sufficient, critical mass, right? To be, they can throw their weight around to make sure that they get frac sand when they need it, right? And not under a smaller guy who, is going to be third or fourth in line, with the suppliers of everything that's needed in the oil field.
Yeah,
So
that's very, very
close attention
critical.
to that.
Yeah.
Yep.
Yeah, you got to make sure your operators adequately capitalized so they don't have any money problems. And Continental doesn't. They're printing money these days.
Yeah.
And then the other thing is, do they have good relationships with their service companies so that they don't have any problems with that kind of stuff? So anyway, it's an interesting story, guys. I like it. And yeah, when I compare it to other minerals companies, yeah, your dividend yield is less, but I like you're deploying this capital to grow the company in assets that are going to generate 20 or 30%, rate of return. That's a great growth story. So some of us are interested in dividends, some of us are interested in growth. So
and we're trying to demonstrate that we'll continue as we royalty volumes increase and our cash flow increases, especially. That's the real catalyst in the near term, is our royalty volumes increasing, our old COVID hedges roll off over the next couple of quarters. And after that, our cash flow is going to be really serious. And we'll, as a percent of our cash flow, we'll slowly increase that dividend as we've demonstrated over the last few quarters.
Okay, good.
Yeah.
Now you're really using collars now, right? You're doing costless collars as much as you can.
Yes.
On the gas side, good. Yeah, that's what we like. Why don't we'll close it here, and I'll just tell you a great story. For this stage, what a company that I think you're really investing in the team. And I would tell all you guys to go to their website and look at their board and their management team. A lot of seasoned guys. That really looks good. And I just want to remind everybody, PHX is also going to host a luncheon for us in Houston. I think we're still set for May 24th, correct?
Yes.
Yes.
Okay. So we got that up on the website now. If you live in the Houston area and you want to come meet these guys and hear the story again, that'd be great. And we're really trying to get our luncheon program going again. I've actually got 3 companies that have paid me for a luncheon, but they haven't picked the date. So sooner or later, we'll get those things set up. But then we'll just end it here. Thank you again. And we look forward to meeting you personally on the 24th and hearing the story. Going to be great.
Thanks very much. Everybody have a good day.
Thanks, everybody.
All right.